Hi, this is Damon King, Certified Financial Planner and Wealth Management Specialist with Chapelwood Financial Services. And in this special video, what are we addressing? Well, what else? The coronavirus. That is the huge news affecting the markets and the economy right now. We've also had some extra things added to that. We're going to talk about that in this short video. But primarily what I want to do this video for, and we've been doing this a lot here over the last couple of weeks as the coronavirus has spread around the world, and now it is really making a foothold here in the United States. The purpose of this video is calm. The purpose of this video is just calm down. I had a client that emailed me earlier this week, and she said, kind of jokingly, but also probably half serious, "Talk me off the ledge. Talk me off the cliff here. You know, I want to jump. I want to run for safety, but tell me why I shouldn't." And so that's what I want to do in this video, is not just tell you, look, stay the course. Okay, that's what you should do. I want to explain why you should do it, at least from my perspective. And look, as a financial advisor, I'm trained to look at things objectively, look at things logically. Victoria is as well here in our office. And, you know, we do a pretty good job of that. But we're also human. We see what's going on in the market. We're investors as well. And so we see what it's doing to our accounts. We know what it's doing to your accounts. And sometimes, yeah, it's hard to keep it together. It's hard not to react. So if you're sitting there thinking, how do you guys stay so calm? Well, sometimes even we are like, oh my God, please, stock market, just work with us, please. But these things happen. If you're going to invest in the stock market, you have to understand and accept that downs are going to be a part of mostly ups. I mean, we've been in an 11-year expansion in the economy, the longest economic expansion in U.S. history. So we've kind of forgotten what it's like to have a situation like this. So what is happening? Well, it's twofold, really. The coronavirus we've known about, it hit late 2019, and now it has finally started to infiltrate the United States. And until late February, the U.S. market really was largely unaffected. We didn't think that it was a big deal. While it seemed to be an Asia and Europe problem, we didn't really care about all that much. Now, coronavirus cases are spreading across the United States. We've actually had some deaths now. That didn't happen for quite some time. So now people are understandably nervous, and the market is reacting very violently. I mean, we had 1 week where in 1 week, the span of 1 week, we saw the largest point decline and the largest point increase within 2 days of each other. That is the poster child for volatility, and it's going to continue happening. Then we had something else happen just this past weekend. Saudi Arabia decided that they were going to play hardball with their OPEC partners, particularly Russia. And even while global oil demand is down, Saudi Arabia, to try to increase their market share, to try to drive sales of their own oil, they continued to increase production. That had the effect of lowering prices to levels that we haven't seen in quite some time. So you've got this double whammy of the virus and oil. However, there is still reason for optimism. There is still reason to stay calm in this situation. These things do happen. And so I'm going to show you a couple of charts, and then I'm going to give you some parting advice at the end of this as to why you should not be panicking at this time. This first little graphic shows how the average investor reacts to the market, as well as why the average investor far underperforms the market on a long-term basis. What we're seeing right now with the wild ups and downs of the market, keep in mind that for 11 years we have been in an upward trend. Since the 2008 financial crisis, we have been in the longest market expansion, the longest economic expansion in U.S. history, 11 years. And for much of that time, you'll notice that it was optimism, excitement, thrill, euphoria. This is how the average investor, this is how the typical market reacts, investors in the market. If you sell right down here, you probably bought somewhere up here. Now you're selling right down here. If you sell right now, you are absolutely locking in losses. This is why the broader market over a 20-30 year span will return 9 to 10%. The average investor will get about 3 to 3.5%, precisely because they buy high and sell low. So that's how the average investor reacts when the market is doing what it's doing. If you're one of our clients and you came to us originally and you said, you know what, I have a high level of risk tolerance, I can deal with the ups and downs of the market because I understand that in general the market generally goes up. This is one of those times where you prove to yourself, I really can take on, I really can stomach some of this risk. Many of our clients chose to protect some of their money very early on. If you have protected some of your money, one of the things I've been reminding clients in our strategy reviews is, remember, this is why we built a little storm shelter for 25 to 33% of your wealth just for this situation. So remain calm. You've got a good portion of your money that is not subjected to any loss at all. All right. Meanwhile, your investments are going to rebound. All right. They are going to rebound. All right. Let me show you another chart. We've talked about what is the average investor doing and why do we see these wild swings in the market. Well, what about the coronavirus itself? How does the market react immediately after and generally in the short and long term right after a major outbreak like we're seeing? This little chart right here is probably one of my favorite that I've seen during this entire episode with the coronavirus. This is showing you world epidemics going all the way back to the HIV/AIDS outbreak of 1981. Notice what the market does immediately after the World Health Organization declares a global emergency and then in the 3 to 6 months after that point. What you have to understand is that these things do get contained eventually. They do run their courses. Just like any disease, they run their course. After each one of these major pandemics, there is a major market pullback for typically a very short amount of time relative to, certainly relative to the time frame of your retirement. And within a short amount of time, the market comes back up. So I wanted you to see this so that you can take some heart and realize that this has happened before. This is not new. There have been 1, 2, 3, 4, 5, 6, 7, 8, and now 9 with the coronavirus. We have had 9 of these outbreaks since the financial crisis of 2008. Yet, during that entire time, the economy of the United States, the market in the United States, and really globally, has risen, has grown. These things happen, they run their course, and then the market does recover. It is almost invariable that that happens. So, in closing, again, my main message here is calm. Maintain your composure. I mean, I could go crazy. We as advisors, Victoria and I, we could go crazy. We could panic. Okay? But think about flying in an airplane. I promise you, the pilot of your airplane would much rather fly in sunny skies all the time. They never want to have to fly through a thunderstorm. But sometimes, to get from point A to point B, you have to fly through a thunderstorm. You trust your pilot to get through the turbulence, to get through the storm. Now is the time, if you have hired an advisor, and certainly for clients of Chapelwood Financial, this is where we really do our best work, is helping you to see not just how you're invested, but why you're invested. Why is your money where it is? It's likely going to be volatile for quite some time, so just prepare yourselves for it. Ultimately, what I want you to focus on is not the stock market. I want you to focus on your stock market. I want you to focus on how your plan was constructed. Remember that your plan is not dependent upon the complete up and down of the market. Your plan is dependent upon one thing, at least in retirement, that is not running out of money. That is the ultimate goal of this game. Don't run out of money. So remember, your buckets are there for a reason. You are looking for 5 and 6% returns over a 25 to 30 year period. We're not going to worry about even a 10% or 15% decline within the span of a couple of months. Calm. This will pass. You will make it through the rain. And as your advisors, Chapelwood Financial, We're your pilots. We are in control. We've got this. You've got this. You're going to be okay. Thank you so much for watching. Please be sure to hit that subscribe button, like us, share us. We send out all kinds of videos and content like this. So if you want to get a notification every time we have a new video, please subscribe to the Financial Diva channel. Also, go to iTunes and subscribe to our podcast. It's all about the money, honey. You get all of our great podcasts, all of our great information that we upload every week. Thank you so much for watching, and stay safe out there. We'll talk to you next time.